No, the market didn't beat you. You beat yourself. Today, I'll show you the secret every consistent trader follows. A rule that turns noise into clarity, chaos into structure, and hesitation into controlled execution. It's simple. Patience is a position. You either hold it or you pay for not holding it. If you've ever stared at a chart waiting for a setup and entered anyway, this video will break that cycle. By the end, you'll know why your mind rushes, how the market punishes that rush, and how to build the kind of discipline that protects your capital and your confidence. Let's get started. Most traders believe they lose because they picked the wrong direction. They blame the chart, the indicator, the entry candle, or the sudden spike that wiped out their stop. But the real enemy comes much earlier. It begins with a tiny moment of restlessness, a slight urge to act, feeling that the market is slipping away and they need to do something. That's the seed of impatience, and once it's planted, every decision that follows becomes rushed, reactive, and emotionally charged. Most traders never notice this shift. They think they're being strategic. They think they've spotted something subtle. But in reality, they are falling into the same trap the market sets every day, forcing trades before the market is ready. Impatience doesn't announce itself. It doesn't show up with alarms or warnings. It creeps in quietly. 1 second, you're analyzing the chart, and the next you're imagining what could happen if you don't enter now. You fear missing a move. You fear watching the market run without you. And in that emotional rush, you confuse urgency with opportunity. You mistake movement for direction. You start interpreting noise as signals. Every trader has done this. You see a candle break a minor level and immediately assume it's the beginning of the real move. You skip confirmation. You ignore structure. You tell yourself, "I'll manage risk," as if that excuses the poor timing, but the market doesn't reward excuses. It rewards discipline. The hidden cost of impatience isn't just the money you lose on the trade. It's the damage it does to your confidence. Every rush decision chips away at your mental clarity. You start second, guessing your strategy. You hesitate on the next setup. You tighten stops too early. You exit winners before they develop. Soon, you're trading from a place of fear instead of structure. That internal erosion is far more dangerous than any stop-out. When you lose confidence, you lose your edge. And when you lose your edge, the market becomes a battlefield instead of a business. Impatience creates a feedback loop. You rush into a weak setup, lose, feel regret, and then try to make it back with another impulsive trade. Before long, you're trapped in a cycle that has nothing to do with analysis or strategy. It's pure emotion. The market becomes a mirror reflecting your lack of control. The worst part is that traders mistake this emotional volatility for volatility in the chart. They say the market is choppy. They say it's unpredictable. They say it's manipulated, but the real issue is internal, not external. The market hasn't changed, the trader has. Professional traders understand something most retail traders don't. Waiting is a position. Sitting out is a position. Doing nothing is a position. Patience is a form of capital, just like money. And every time you enter early, you spend that capital carelessly. Professionals don't win because they know more. They win because they wait more. While impatient traders jump into every wiggle, professionals watch. They observe, they track levels. They let the market reveal its intention over time. They wait for proof instead of reacting to hints. Every premature entry comes with a hidden cost, emotional fatigue, strategic confusion, and the slow decay of discipline. The market doesn't punish traders for being wrong. It punishes them for being early, and impatient traders are always early. They try to catch moves that haven't matured. They chase breakouts that haven't confirmed. They treat every pullback like a reversal. Over time, these small misjudgments accumulate into big losses, not because the strategy is flawed, but because the timing is impulsive. The truth is simple. You don't need more setups. You don't need more indicators. You don't need more screen time. Need more patience. Until you master this, every strategy will eventually fail you. But when you master patience, even a simple setup becomes powerful. Patience forces you to wait for the best opportunities, and the market always pays those who wait. Your brain is not designed for modern trading. It wasn't built for charts, candlesticks, or price levels. It was built for survival, fast reactions, instant decisions, and immediate reward. That's why trading feels so difficult. The market demands patience, but your brain demands action, and when these two forces collide, your account suffers. Understanding this is the first step to controlling it, because every impulsive trade has a biological origin long before it becomes a financial loss. The human mind hates uncertainty. It hates waiting without knowing what happens next. When you stare at a chart, you're looking at constant uncertainty, price moving, ticking, shifting, teasing. Your brain wants to resolve that tension as fast as possible. It wants closure. It wants the discomfort to end. So it pushes you to act. It whispers, enter now, do something, don't just sit here. That's not strategy. That's survival instinct. And survival instinct is the enemy of disciplined trading. Then comes dopamine, the brain's reward chemical. Every time the market moves in your favor, your brain releases a small hit. This creates a dangerous loop. You start associating trading with excitement rather than logic. Even the anticipation of a trade releases dopamine that alone can push you into premature decisions. You aren't trading a setup, you're chasing a feeling. The rush becomes the reward, and the outcome becomes secondary. This is the psychological root of overtrading. Charts make the problem worse. They move constantly, they flicker, they tempt you with possibility. A tiny breakout, a sudden candle, a spike of volume. Your mind interprets these as signals, even when they're meaningless. It's not your strategy seeing opportunity, it's your brain seeking stimulation. The faster the market moves, stronger the urge becomes. This is why traders chase breakouts that have no structure. This is why traders jump into reversals they didn't plan. This is why traders enter halfway through a move they already missed. The brain hates the feeling of being left out, so it pushes you to avoid it. Fear of missing out is not a trading problem, it's a biological one. FOMO activates the same neural pathways as physical loss. Your brain treats a missed opportunity like a threat, so you click early, you justify it with logic. The chart looks good, it's about to run, if I wait I'll miss the move. But none of this is true. These thoughts are emotional camouflage. The real driver is fear. A fear your brain amplifies because it thinks you're avoiding danger rather than protecting your capital. There's another layer, the illusion of control. When you're not in a trade, the market feels chaotic. You feel powerless, but the moment you enter, even if it's the worst possible entry, you feel in control again. You feel involved. You feel like you're doing something. That emotional relief tricks you into believing early entries are justified. But this is a dangerous lie. You're not in control. You're just reacting, and reacting always leads to losses. Your brain is designed to protect you from threats, not from bad trades. That means you must override its programming. You must train it to tolerate waiting. You must reward discipline instead of excitement. You must replace urgency with clarity. The more you understand how your mind sabotages your trading, the easier it becomes to stop the cycle. Trading is not a test of intelligence. It's a test of emotional control. And until you learn to master your brain's impulses, the market will always stay one step ahead of you. Every trader wants certainty. They want to know the exact moment a move will start, the exact candle that signals strength, the exact level where the market will explode. But the market never gives certainty up front. It tests you, it waits, it plays with your expectations, and in that waiting period, most traders make their biggest mistake. They assume a setup exists before it actually forms. They see potential and treat it as confirmation. They confuse anticipation with evidence. That's how impatience turns a harmless idea into a painful loss. The truth is simple. Real setups are slow. They need time, they need structure, they need a story behind them. A clean trend, a pullback, a clear level, a shift in momentum, a reaction from buyers or sellers. These pieces come together, gradually like gears locking into place, and when they finally align, the market reveals its intent without ambiguity. You don't have to guess. You don't have to force an entry. You don't have to beg the chart for answers. The setup shows itself because real setups don't rush. The market communicates through behavior, not noise, a level holding after multiple tests, a breakout that comes with conviction, a pullback that forms higher lows, a consolidation that tightens while volume contracts. These details aren't random. They're the market telling you what it wants, but you only hear the message if you're patient enough to wait for it. Impatient traders look at the same chart and see something completely different. They see a candle spike and assume it's momentum. They see a tiny breakout and assume its strength. They see movement and assume meaning. But assumptions aren't setups. They're emotional shortcuts. A real setup never lies because it requires proof. It demands confirmation before action. It forces you to slow down and observe the market's character, not just its movement. Fake setups offer excitement. Real setups offer clarity, and clarity is what separates skilled traders from desperate ones. When you wait for confirmation, the chart becomes predictable. Not perfectly, but enough to remove impulse from your decisions. Enough to anchor your execution in logic instead of anxiety. Think of the difference between a spark and a flame. A spark is sudden, bright, exciting, but it dies quickly. That's what most impatient traders chase. Tiny bursts that look like something big. A flame is steady, controlled, strong, built over time. That's what a real setup is. It doesn't rush. It builds pressure. It shows intention, and once it ignites, it carries momentum with purpose. The reason real setups work is because they align with the behavior of large players. Institutions don't act impulsively. They accumulate, distribute, test levels, trap liquidity, and wait for the right moment to strike. Their footprint is visible if you're patient enough to let it appear. When you enter early before the footprint forms, you're trading against guesswork. When you wait for the structure to reveal itself, you're trading with the market's true direction. The problem is that waiting feels slow. Watching price move without being in a trade feels painful. Seeing a candle touch your level and not entering feels like hesitation. But this discomfort is a requirement. The trader who cannot sit through that discomfort will always be early, always be exposed, always be vulnerable. The trader who can wait becomes selective, and selectivity is the strongest form of edge any trader can have. A setup that never lies follows one principle. Let the market prove itself. Let it show strength. Let it show rejection. Let it show momentum. Let it show commitment. When you wait for the market to reveal these signs, your entries become cleaner. Your risk becomes smaller, your confidence becomes stronger, you stop chasing, you start choosing, and when you start choosing, everything changes. There was a day when the market gave every trader the same bait. It was drifting upward, slow, uneven, unclear, not strong enough to trust, not weak enough to fade. It was the kind of price action that invites speculation. Early buyers stepped in with hope rather than confirmation. They wanted to be the first ones in. They wanted to catch the move before it gained traction, and every one of them paid for it. I watched them get chopped out one by one, stopped out at the same levels, repeating the same mistake. They weren't trading setups. They were trading anticipation, but I did nothing, not because I knew what would happen next, but because nothing in that moment deserved my capital. The market was flat, liquidity was thin, and momentum lacked conviction. I watched the candles print, but the story wasn't complete. I wanted structure. I wanted a shift in character. I wanted the market to reveal intention instead of potential. That waiting wasn't easy. Every tiny spike invited temptation. Every small breakout felt like maybe this time it would run, and every time the market snapped back, punishing the early entries, then something changed. It wasn't dramatic. It wasn't obvious, but it was real. Price approached a level it had rejected twice earlier in the session. This time the rejection wasn't sharp. It paused, it absorbed, it held. Sellers pushed, but they couldn't drive it back down. Volume tightened. Range narrowed. The market was gathering pressure instead of releasing it. That moment told me everything the earlier noise couldn't. Buyers were positioning. Liquidity was shifting. Intent was forming beneath the surface. I waited for one more piece of confirmation. A clear displacement, a clean break with follow through, not a spike, not a wiggle, a decisive move. And when it came, it wasn't subtle. The breakout snapped through resistance with strength. Not a desperate move, not a random pop, a deliberate push, the kind that comes from real orders, the kind that signals commitment. That was the moment impatience punished the crowd and rewarded the patient. I entered exactly where others had exited. They lost because they tried to predict. I won because I waited for proof. Funny part is that the best part of the entire trade wasn't the entry, it wasn't the breakout, it wasn't the profit, it was the trade I didn't take earlier. Every avoided bad trade strengthened discipline, every avoided trap builds confidence, every avoided impulse protects your capital. Sitting out isn't passive, it's strategic. That day taught me something most traders never learn. Market pays you for restraint more than it pays you for action. The trade you skip is often more important than the trade you take, because every avoided mistake compounds just like every profit. When you stop entering early, your losses shrink, your stress disappears, your clarity improves, and once your mind clears, the right trades become obvious. The crowd entered because they wanted the market to move. I entered because the market proved it was ready. That difference is everything. The trade I didn't take saved my account more than the trade I did take grew it, and that's why patience will always be the strongest skill a trader can master. Patience isn't a personality trait, it's a system. Without structure, your mind will default to emotion. Without rules, your decision will default to impulse. Traders lose because they rely on willpower instead of a framework. Willpower collapses under stress. A framework doesn't. A framework is what keeps you grounded when the market tries to drag you into its noise. If you rely on discipline alone, you'll crack the moment a candle spikes or a fake breakout appears. But when you build a structured plan that forces patience, you remove the need to fight yourself. You turn patience into a repeatable behavior instead of a daily struggle. It starts with defining your setup, not 5 setups, not 10, 1. The setup must be so precise that anything outside its criteria is automatically disqualified. This eliminates 90% of impulsive entries. When your brain has only one pattern to look for, it stops chasing everything else. Your setup becomes your filter. Every chart either qualifies or it doesn't. No guesswork, no maybe, no emotional interpretation. This step alone can transform your trading because it strips away the false sense of opportunity that fuels impatience. The second part is even more important. No signal, no trade, no exceptions. Exceptions are where traders lose their discipline. They rationalize shortcuts because the chart looks good. They enter early because they want to anticipate the move. They break their own rules because they fear missing out. But when you commit to a rule that cannot be bent, you remove the emotional wiggle room that destroys patience. A fixed rule becomes your shield. It protects you from yourself. Next, remove the temptation to stare at charts all day. Staring at price action creates emotional tension. It stresses your mind. It creates the illusion of urgency. The longer you watch, the more your brain tries to resolve the discomfort by forcing trades. This is why alerts are essential. Alerts create distance. They allow you to step back and give the market space to form structure. They reduce the influence of impulse and make every decision cleaner. When you only look at the chart once the alert triggers, you're entering the market with a calm mind, not a restless one. Another powerful tool is a daily trade limit. When you cap the number of trades you can take, 1, 2, or 3, you force yourself to be selective. Selectivity creates patience. If you know you can only take 2 trades, you won't waste one on a weak setup. You'll wait, you'll filter, you'll think, you'll demand quality. This naturally eliminates overtrading and reinforces disciplined behavior. The market offers endless opportunities. Your job is not to catch them all. Your job is to catch only the ones that matter. The final piece is understanding that inaction is a strategic position. Doing nothing is not hesitation. Doing nothing is not weakness. Doing nothing is not missing out. Doing nothing is a decision to protect your capital, preserve your clarity, and wait for the market to come to you. Professionals thrive because they know when not to trade, they know when to step aside, they know when the market is untradeable. Patience isn't passive, it's protective. When you combine these elements, 1 setup, 0 exceptions. Alerts instead of staring, trade limits, and strategic inaction. You build a framework that makes patience automatic. It removes emotion from the equation. It gives your mind structure. It gives your decisions clarity. And once patience becomes a system instead of a struggle, your trading transforms, your entries improve, your losses shrink, your confidence grows, you stop reacting to the market and start controlling your environment. That is what unshakable patience looks like. Not a feeling, not a mindset, a framework. Most traders look for fast results. They look for the quick fix. Secret indicator, the shortcut that will magically erase years of emotional habits. But trading doesn't change in a single moment. It changes through repetition, through discipline, through small, consistent actions that slowly rewire the way you think. That's why a 30-day challenge is so powerful. It creates structure. It forces accountability. It transforms patience from something you try to something you practice, and practice is what builds mastery. The challenge begins with one rule. For the next 30 days, you take only your Atlas setup, not the setups you like, not the setups that look almost right, not the setups your emotions try to justify, only the setup that meets every requirement of your plan. At first, this will feel restrictive. Your brain will beg you to take trades that don't qualify. It will tell you that this one time is different. It will tempt you with flickers of movement and sudden spikes, but the entire point of the challenge is to break that mental pattern. Every time you resist temptation, you strengthen the muscle of discipline, and every time you give in, you weaken it. The second rule is simple but transformative. Log every urge to enter early. Don't ignore it. Don't pretend it isn't there. Write it down. Capture what you felt, what you saw, what triggered the impulse. This forces awareness. You start recognizing your own weaknesses. In real time, you see patterns in your behavior, you realize your triggers, you understand your impulses instead of blindly acting on them. Awareness is the foundation of control. Once you see the emotional mechanics behind your decisions, you're no longer controlled by them. Then comes the daily rating. Every evening, rate your patience from 1 to 10. Be honest. Did you wait? Did you hesitate? Did you follow your rules? Did you feel restless? This simple rating system builds self-accountability. It creates a feedback loop. It shows you the days you were strong and the days you were vulnerable. Over time, these ratings will reveal the truth about your trading mind, whether you're progressing or repeating the same behavioral mistakes. Each weekend, you review screenshots of setups you took and the setups you avoided. This reflection strengthens objectivity. Start seeing which decisions were justified and which came from emotion. You realize how many bad trades you prevented by simply waiting. You understand how many winning trades came from discipline, not luck. The review process rewires your perception of the market. It shifts your focus from making money to making good decisions, and good decisions always lead to better outcomes. By the end of 30 days, something changes. Your urges become quieter, your clarity becomes sharper, your patience becomes less of a fight and more of a natural behavior. You begin to trust waiting. You begin to trust your framework. You begin to trust yourself. That internal shift is far more valuable than any single winning trade, because once patience becomes part of your identity, the market loses its power to manipulate your emotions. This challenge isn't about perfection, it's about transformation. 30 days of disciplined restraint can undo years of bad habits. 30 days of structure can rebuild your confidence. 30 days of selective trading can reshape the way you approach the market. Most traders chase results. The few who succeed build discipline. And discipline always outperforms impulse.